Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
All right, we've been talking a lot about Tesla this morning. Their delivery numbers came in weaker than expected. We had Dan Ives from Wedbush Securities on earlier, and he was just saying, hey, relative to maybe the whisper number, they came in a little bit better than expected here. But let's get the broad overview of what's happening at our good friends at Tesla. The stock's up about 2.8% today, but it's down about 24% year to date. We turn to Pierre Ferragu, head of global technology infrastructure at New Street Research. Pierre, thanks so much for joining us here. How do you think about these Tesla numbers? What does it mean for the near and intermediate term story at Tesla?
Yes, as you say, there is a bit of a positive surprise, like people tracking very precisely deliveries in various markets were expecting slightly lower numbers. The surprise comes from the US. The US is a place where it's the most difficult to track the number of Tesla being delivered, and the US beat expectations. So that's a Model Y coming in, doing actually quite well. That's good. But then at the end of the day, you have to remember the big picture. We are down 13% year on year. So we are facing a situation where Tesla is struggling to sell cars. Gross margin is in the low teens. To me, Tesla facing good demand should be able to defend like mid 20s gross margin. So we are facing like a core business, an auto business that is really at a very low point that is struggling. And so what's the difficulty? You have like one structural difficulty that we understand relatively well. It's that with their current product, Tesla has kind of saturated its opportunity. Tesla needs lower price points to keep growing. And that's in the plan. They're working on it. And then you have a number of other issues. Electric cars are less fashionable than they were a couple of years ago. The Tesla brand has suffered, particularly in Europe, where numbers are down like almost 40% year on year. And so it's difficult to quantify, but it is a significant headwind as well. And overall, the economy is not the best you can imagine for auto demand.
Yeah, I mean, when we look at the Mag 7 stocks, we see Tesla as the primary laggard this year, down about 23%. And of course, we know that investors have really been vying for Musk's attention as he's been really politically involved. So as we're seeing these numbers come through, what do things look like moving forward? Are these numbers a massive impact, or are the Tesla loyalists still out there? And is there some further positivity to come?
Yes, the Tesla stock has been on a roller coaster. It's like a very low performer this year, but it was like a clear outperformer last year. And as you say, it's following the political career, if I may say, of the CEO, Elon Musk. This has created this situation. Now, if you look at the stock, since, April 1st, what you see is that what tends to really move the stock is actually the news flow around how the company is now focused on deploying fleets of robotaxis. They've just started that in a couple of weeks ago, like late last month. And I think that's going to be the primary driver of the stock going forward. Right. Of course, there is a lot of uncertainty on how fast Tesla is going to be able to deploy a robotaxi or even make profits, like generate the profits out of a robotaxi fleet. But the size of the price is so gigantic and so much more than the auto business that this is probably what drives the stock going forward.
Pierre, thank you so much for joining us. Always appreciate getting your thoughts there. Pierre Ferragu, he's head of global technology infrastructure at New Street Research.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
All right, let's get back to Tesla. It's been a name we've been talking about today. They reported some delivery numbers. Came in a little bit light of forecast. Stock's up a little bit today, and Dan Ives from Wedbush Securities suggested that might be because the whisper numbers out there were a little bit lower, so the company exceeded them. So we're there. But there's certainly been some negative sentiment around Tesla stock. It's down 25% year to date. There's some concerns about Elon Musk and his commitment to the company. But there's still a lot to like out there about Tesla if you look at the numbers. And that's what our next guest does. Matt Winkler, he's editor-in-chief emeritus of Bloomberg News. He founded Bloomberg News. To me, that's the point here. And he joins us here in our Bloomberg Interactive Broker studio. Matt, thanks so much for joining us. You've got a column out today with your colleague Shin Pei saying, hey, if you look at the numbers here at Tesla, it's an extraordinary story still.
Yeah, and by the way, thank you for having me. And I would invoke our founder, Mike Bloomberg himself, who, when he was mayor of New York, would say often, in God we trust, everyone else bring data.
Yep.
And so the data compiled by Bloomberg shows that this EV startup we call Tesla, founded by engineers Martin Eberhard and Mark Tarpenning in 2003, is still the world's largest automaker, 9th largest public company, and worth more than the gross domestic product of Saudi Arabia. And for all its might as a global sales leader, Toyota Motor Corp is about a quarter of Tesla's more than $1 trillion valuation as of today, after the very numbers that you reported. And by the way, the stock is up the most since June.
Yep.
Okay, so initially, the media take was negative, 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 and people with the most at stake, which is where the data is, say, not so fast. And there's a reason for that. You know, what we did, my colleague Shin Pei and I, is we asked that very question. Okay, with all this negative news that is prevailing, that is the prevailing narrative, why is it that through thick and thin, every single month this year, Tesla is still worth more than Toyota? And Bloomberg's own alternative artificial intelligence function, DSX, tells us there are plenty of reasons. One is that if you just took out the vehicle itself, there's still $1 trillion market capitalization on the autonomous driving that is coming soon to everyone through Tesla. So there are all kinds of reasons why Tesla has the value that it has. But I would like to share with you something that I got from a Bloomberg user this morning, an email. He said, we don't need AI to understand why Tesla critics are losing. Critics are either motivated by hate, we've seen that, politics, or a misunderstanding of time. Tesla represents the most extraordinary array of products, some of which are destined to become core components of the future economy and life of humanity. That's from our Bloomberg user, John Billings, who's in Washington, D.C. So this is a big part of the story that everybody misses. And if you just look at quarterly sales reports, that's not going to give you the picture. But I would say even in that context, the Model Y was the best-selling vehicle in the world in 2023, 2024, and poised to be certainly the best EV selling vehicle in 2025, and maybe again repeat. And the reason why the deliveries were slow in the first and the second quarter was because they were retooling, renovating, updating the Model Y. Sales are way up in Norway and Spain, by the way. So much for the demand problem.
How are you thinking about it in relation to peers? I mean, I know a lot of people have really been clamoring for Musk to turn his attention back to Tesla. And I mean, when we think about some of these numbers that we're parsing, as you mentioned, and your story, that everything about Tesla these days has really been ranging from bad to worse. So when you think about the future of the company in comparison to peers, you know, what are just some of the things that you expect in terms of performance moving forward?
Well, let's just look at the past 10 years. By the way, 2015, most of the analysts that provide forecasts were negative about Tesla, bearish, don't buy the stock. But what happened? Tesla's $97.7 billion of revenue last year is more than 30 times its sales a decade ago. Now that outperforms even China's BYD, which has been the star of late in the media narrative. But if you look at something like Tesla's earnings before interest, taxes, depreciation, amortization, it's more than 300 times the company's profit a decade ago. Number two, BYD grew only 15 times. You know, if you look at Tesla's current market capitalization, it's 31 times its value a decade ago, which is just another way of saying that among the top 10 automakers that Tesla competes with, Tesla's revenue growth, its profit, and its market value are superior, according to data compiled by Bloomberg.
Always. Brand value, last question. One could argue the valuation has always had a big Elon Musk premium based into it. His brand arguably has been diminished over the last 6 months with his political actions in Doge. Is that a concern, or should it be a concern for investors? And you think, is there a long-term brand issue, do you think?
So I'm not qualified to answer that question. However, somebody who probably is Nicholas Colas, who's the co-founder of DataTrek. And he's been covering the auto industry since the 1980s, which is kind of when I sort of entered the picture. And he says there's something that is no algo spreadsheet can understand, which is why hero-led companies are often so valuable.
Yep, interesting. All right, Matt, great column. As always, Matt Winkler, Editor-in-Chief Emeritus, founder of Bloomberg News. I think he drives around one of these Tesla things. I kind of went there last time. I got my youngest a hybrid Honda, so I'm kind of getting there. But give me the gas engine. Give me the gas engine. Matt Winkler, thank you so much. We appreciate that.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
I tell you, one of the more competitive industries I see out there day in and day out is the wireless business. You got the big three, AT&T, Verizon, T-Mobile, and it's all, I mean, it's all on price. I mean, it's all kind of the same. I don't know. That being said, I've been with Verizon since the beginning of wireless, so maybe
likewise.
Yeah, no churn going there. John Butler, he covers all this stuff for Bloomberg Intelligence. John Butler, senior telecom analyst for Bloomberg Intelligence. He's based down there in Princeton, New Jersey. John, what's the state of the wireless industry today? Again, you've got those big three. How competitive is it?
Hyper competitive, Paul. It really is interesting. Just as you said, there's a lot. The big three, AT&T, Verizon, T-Mobile, they're always slugging it out with themselves. But now that you've got the cable operators coming in, offering wireless at very enticing price points, and their brand strength is getting better. And so they're becoming more and more of an issue quarter in and quarter out. What we as analysts sort of measure as the health of a telecom in any given quarter is we look at the number of net new smartphone subscribers that a carrier adds, or phone net adds as they're called. And what we've seen every quarter is the cable operators now are getting even up to half the net adds in a given quarter. So they're becoming a big factor. Having said all that, I'm impressed with how the carriers are keeping their service revenue growth pretty steady. You know, telecom is not a growth business, so if you're getting 3 to 5% growth in your service revenue, it's a pretty good quarter, and I think we're in for more of that this quarter, with the exception of Verizon, and we can talk more about that if you want.
Mm-hmm. John, when I think about wireless carriers and I think about some of these phone providers, it feels as though everyone has their brand that they stick to. And as we were mentioning earlier, it doesn't really feel like there's necessarily anything to entice people to hop around. But given all of this in regards to marketing or really just being able to drive demand, where are you seeing, which company are you seeing as the biggest leader here?
T-Mobile is the runaway hit, Norah.
T-Mobile Tuesdays.
They really... Yeah. T-Mobile Tuesdays, they have giveaways once a week. They're brilliant marketers, just brilliant. And it's funny, if you rewind the clock 15 years, they had a near-death experience. Like, I didn't think that carrier was going to make it. They brought in a very dynamic CEO named John Ledger, who really turned around the brand. He made himself the face of the brand. They branded it as this sort of hip counterculture, consumer-friendly brand. People just love it. And in the meantime, they've done a great job updating the network and upgrading it. So, and after buying Sprint, of course, they now have the scale to really compete with AT&T and Verizon. They've gone from a distant third in the industry to now the second largest wireless carrier. And they lead the industry in net adds quarter in and quarter out, which is a testament to the power of their marketing.
All right, I'm a Verizon wireless customer, been one since the beginning of this whole wireless thing.
Me too, by the way.
Exactly. So what's the story for those guys in terms of how they're dealing with the competition?
I think it's easy to sort of play armchair CEO here, but I think Verizon is making a bit of a mistake by not meeting rivals in promotions. They really take the high ground. They want to protect a premium brand image. For years and years, they had the best network out there. I still think they have the edge there, but that gap is closing, particularly in the minds of a lot of consumers that don't follow the industry. T-Mobile keeps banging away that they have the best network in the US, and so that sort of premium brand image that Verizon had is beginning to erode, and yet they're not meeting T-Mobile or the cable guys sort of, tit for tat on promotions. And so on the margin, in recent quarters at least, they've lost phone subscribers. Not a lot, but it's beginning to really chip away for them, and it's chipping away at their service revenue growth, again, because I just don't think they're promoting enough.
John, so you've got the big three. What is the latest with M&A in this space? Is there anything left to consolidate?
Not much, Norah. There's been where the telcos are really looking for growth is on the broadband side, and you've seen a lot of consolidation there with Verizon most recently buying Frontier, which is a big fiber provider. They really have strength in several states across the U.S. AT&T has done a really good job. They're buying Lumen's fiber business, so you've got consolidation there. On the wireless side, you've seen T-Mobile snapping up a lot of the independent and private prepaid brands like Mint Mobile is one of their most recent. They're buying TDS, which is a small regional wireless carrier. So there really is nothing left here except for big transformational acquisitions, and they really would be gigantic on that scale. So I'm just not seeing it.
So, John, just real quickly here, is this an ARPU story? Is this just raising prices to consumers? Is that the growth story here for most of these big guys? It's
raising prices, Paul. Definitely. That's how you're getting that 3 to 5% service revenue growth. But I think another part of the story and one to watch is that telco expansion into broadband. They're doing a great job there, expanding into fiber, and both that and fixed wireless access, which is getting broadband over the air. So I think we're going to see a lot of growth, an increasing amount of growth, to be precise, in coming quarters coming from that end of the business.
All right, John, thanks so much for joining us. Always appreciate getting the update from you. John Butler, he's a senior telecom analyst for Bloomberg Intelligence. He's based down there in our Princeton office. Looking at this, the telecom stocks here, they've actually got some decent returns this year. I was looking at AT&T, Verizon, T-Mobile. AT&T year to date's up 25%. Verizon's up 9% and T-Mobile's up 8%. And on a trailing 12-month basis, AT&T's up 50%, Verizon 6%, and T-Mobile 33%. So for stocks that kind of grow top line, as John was saying, kind of 3 to 5%, some pretty decent returns as they try to expand their business lines away from their core wireline and wireless and get increasingly into broadband. So we'll keep an eye on some of those telecom names.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Jeffrey Palma joins us, Senior Vice President and Head of Multi-Asset Solutions. I'm not sure what that is, but I'm going to say it has to do with some alternative investments, maybe some real investments like real estate. Jeff, thanks so much for joining us here. Cohen and Steers, I've known this asset manager on the street forever, but I've never done business with them because you don't really own media stocks, which was my game. You guys own real estate, REITs, stuff like that. Talk to us about how you guys look at the marketplace and where you see opportunity.
Yeah, so thanks for having me this morning. So we focus, as you mentioned, on real assets and alternative income strategies. And those real asset strategies in particular, real estate, infrastructure, commodities, natural resource equities. In short, things that are exposed to the real economy, that have real ties to the economy, inflation-sensitive assets. So that's certainly been a really important part of the world these days. And then that all kind of fits in also to that alternatives universe that we think offers diversification to your traditional stock and bond portfolio.
So I cover REITs for our equities team, so super happy to have you here. As I'm looking at REITs performance this year, I mean, we're seeing shares that didn't really do much. I'm looking at a gauge that's up about 0.4% so far this year. What are you seeing in terms of performance and opportunities within the REIT space? Any particular subsectors that you're keeping an eye on?
Yeah, so I mean, we should also kind of think about the year has already been full of a whole bunch of rotation. It was a pretty good first quarter for REITs. They've cooled off a little bit in the second quarter, and that sort of is the mirror image from the broader S&P. Broadly speaking, we think that REITs are pretty fairly valued, actually, attractive relative to broader equity markets. Within the REIT space, there's certain areas that we like, and then within the private real estate space, I would also add, there's areas like open air shopping centers that have become, to us, we think are finding a bottom, and in that private space is a little bit different than the listed space as well.
In private space, I always make the mistake of commercial real estate just thinking, oh, it's office. But I know it's now so much more. I've now learned that through people kind of pointing it out to me. In commercial real estate broadly defined, where do you guys see value in the private side?
Yeah. So Norah will tell you that office is only about 3 or 4% of the total listed index. Now, that's down, and our team has been underweight office for a long time. And so we've really benefited from that trade. So within that space, I mentioned in the private space that open air retail looks a little bit better. In listed markets, we've favored things like multifamily homes. Within healthcare, maybe a little bit nichier, but senior living areas. Certainly data centers have been a very important part. That's true not only in real estate, but also things tied to that in the infrastructure space as well.
So you mentioned open air shopping centers. Do you mind just explaining to our listeners what exactly that is? Because I know a lot of people were talking for a long time about the death of the mall. So speak to that.
And this is not quite the mall. It's like the renaissance of the mall, if you like. So think about, in some cases, outlet centers, or in some cases, open air outside where you have necessity-based shopping centers. So it might have a grocery anchor or a big box anchor, things that have durability to the internet shopping cycle. But then it's sort of built around an anchor store. Those are areas where it looks like prices have bottomed. There has not been new supply in the area for the reasons that you mentioned, because malls have been a really tough spot. So yields are pretty good. Earnings growth looks pretty good in that area. And that's why we find some interest in that space.
Where is the capital markets as it relates to real estate these days? If I want to go out and develop a multi-family unit or some kind of piece of commercial real estate, where am I going to get the money to do that? Is my local bank going to lend me that money for a real estate deal?
So obviously the last few years have been really challenging for real estate in general. Debt markets have really been tough. Actually, I think the good news here is that at the margin, the debt markets are starting to open up a little bit. It just means, losses are making their way through. People are kind of realizing some of that. So we are seeing some pickup in lending. There's going to be pockets where that's possible and where there's challenges. So you should think about this less as a national trend and much more as a local, and even in some cases, a hyper local sort of a trade to be able to do it. But the debt financing is coming back, but it's been coming back slowly.
Mm-hmm. Super quickly, I know you mentioned you're underweight office and have been for a while. Any other areas that you guys are actively avoiding?
Well, in certain areas, it's, we've certainly seen an increase in supply sort of working its way through. And that's been, in some cases, apartments and some of those areas, because, that's where the rent growth has been strongest. It's where there's been most resilience in the cycle. But as that supply comes through, it still takes some time to absorb. So that would probably be an area where we've been a little light.
Jeffrey, thank you so much for joining us. Jeffrey Palma, Senior Vice President, Head of Multi-Asset Solutions at Cohen & Steers, and a proud graduate of Rutgers University. I'm a huge fan of Rutgers, the state university of New Jersey. I've hired a ton of kids out of Rutgers over the year, and he joins us here in our Bloomberg Interactive Broker Studio.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.